Hi, everybody. It's Kevin Reardon coming to you from Shakespeare. Happy fall. It is early October 2020. We are in the heart of an election cycle, and we're getting lots of questions about what might happen to the markets after the election results come in. So we thought it would be productive to take a little time to share some information. So let's take a look. Our first slide shows basically that the stock market has marched higher regardless of who's in the White House. And so when you look at this chart, when you see blue, that indicates when we've had a Democratic presidency. In red, you'll see a Republican presidency. And as much as we would hope to find some sort of trend or differentiation, the reality is the markets are moving higher predominantly through the decades, regardless of who's in the White House. Looking across an election cycle was also interesting. So on the left, we know that the stock market on average produces about a 10% rate of return over time. Ironically, during a presidential election year, the market has averaged a higher return of 11.3. On the far right, during the non-election years, years 1 and 3 of a president's term, the markets have been up 14.3. And then actually during midterm elections, which we'll see next in the year 2022, the markets have only averaged 8.6. Our next slide shows how investors typically get nervous during election years and build up cash. And so you can see on the left, in orange or red, that during the presidential election years, money market funds on average bring in 114 billion, but during the non-presidential election years, only 56 billion. Moving on to the right, you'll see stocks and bonds bring in 214 billion during an election year, but even more during the off years, 265 billion. And then focusing in on 2020, money market funds this year have brought in 980 billion versus an outflow from stocks and bonds of 140 billion. So this year, certainly a dramatic difference. I think a lot of that could be attributed to what's going on with the global pandemic, with the social unrest we're facing, and then obviously here with the presidential election. So all three things at work here in 2020. Let's look at a divided government versus a same party government. And so looking to the left at this circular graph, you'll see in yellow that for 47 years, we've had the same party that's been in the White House, in the House of Representatives, and the Senate. And then ironically, 47 years where we've had divided government. So moving to the right, let's first focus on the divided government and how the markets have fared. First, in a one-year period after an election with a divided government, the markets have returned 10.8, and 3 years later, the returns have been 10.9. When we've had the same party, the first year it's been 13.6, and then 3 years later, 10.2. So just comparing the 3-year numbers of a same party versus a divided government, 10.9 versus 10.2, I think that number is relatively insignificant to see any sort of trend or differential. And that leads to our thesis that who's in the White House really isn't of dramatic significance to the markets. If we look at a new president versus an incumbent, here on the left, when we've had a new president, stocks are up an average of 9.3. Looking far to the right, when an incumbent is reelected, markets have averaged 13.4. Then on average in all presidential election years up 11.3. So what policy shifts could we expect given who might end up in the White House? And the reality is I'm not even going to comment on this. And the reason is there's just too many variables. If we were to look at the potential for a Trump re-election, will he be elected with a divided Congress? Will he have a Democratic Congress or Republican Congress? And the same could be said with a Biden presidency. So in taking that a step further, if we just focused on Biden as an example, if he were to win election and have a Democratic Congress, to what extent would the Senate be Democratic? Would they have 51 votes, 55 votes, 59 votes? Those factors will really influence the policy that we'll see moving forward. Until we know more, it's really not worth commenting. So what really matters? And the reality is that innovation is what's driving the markets, and it always has, it always will. To what extent can corporations create new technologies and new solutions? Innovation today in 2020 is moving so much more rapidly than at any point in history, and that will continue to drive the markets. And in fact, that drives productivity gains, which drive the markets. Of course, we need stability in the markets for growth, and we also need open markets. And by this, I don't mean anything to do with regulation. I'm simply referencing, are the markets open? We can go back to April of 2020, where the global pandemic closed restaurants, bars, hotels, airlines. All of those four factors lead to confidence, and confidence is really what drives the market. And what if the election is not determined November 4th? The reality is we've seen that before with the Bush-Gore election and the hanging chads, where the election took weeks to determine the winner. And Goldman Sachs has actually produced an article saying the market has already discounted the reality that we will likely not have a definitive winner that Wednesday, November 4th, when we all wake up. And so that information will continuously be priced into the market each day as we get closer to the markets. But I don't think we'll see any sort of panic November 4th, regardless of the results, or even if we don't have a result. So this has been a Shakespeare Planning podcast. Again, our thesis, although elections do matter, I hope everybody understands that. I don't want to say it differently. They do matter. But when it comes to the stock market, it's been proven they don't matter. Is that what really matters is innovation and productivity gains. So if you have any questions, let us know. We'd love to be of assistance to you. Your team here at Shakespeare's ready and hopeful to talk to you. Thanks. We'll talk soon.